Good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I'm filling in for Prakash this week because he is getting married. He is taking a well-deserved week off, and I will be stepping in for this week just to update you on the equity markets, where we currently stand with regards to the fairly significant rally we've seen over the past 3 weeks, and what our outlook is going forward across the asset classes, across the sectors, and looking at different opportunities here in the broader markets. So starting off with the S&P 500, just yesterday we managed to break just slightly above this 45, just below this 45.50 double top level. Now, this is the first major level of resistance we've seen since we broke out above 4,400, which was the first level of resistance we broke out here from about a week and a half ago. Now, this is on the back of some pretty significant changes here in the equity market since we reversed higher from our end of October reversal here in the equity markets. And what we have seen is really over the past few weeks, a pretty significant shift in investor sentiment on the back of the November FOMC meeting, kind of kicking things off with regards to the potential change in Fed policy to the CPI print last week that confirmed, that the Fed's tightening rate cycle has certainly worked its way through the system and starting to see the benefits of that through the system. Seeing inflation starting to surprise us to the downside has given investors the signal to start deploying some of the vast amounts of cash that has been set aside here in the broader markets for the past couple of years, and starting to challenge these upside resistance levels. So on the S&P 500, we're sitting just shy of this 45.50 double top resistance level. And that simply means that, on the back of what has been a really strong rally here over the past 3 weeks, we're starting to reach levels that are quite overbought, quite exhausted to the upside, and also facing some resistance levels here to the upside. We see this both on the S&P 500 as well as on the NASDAQ 100, which is challenging that 390 double top level here on QQQ, and potentially challenging the all-time highs. So both the NASDAQ 100 and the S&P 500 are sitting near major resistance levels, potentially on the verge of breaking out. Now, if the S&P and the NASDAQ break out, we certainly see a pretty strong signal to revisit the all-time highs on both the S&P and the NASDAQ 100, and would provide a fairly significant and strong bullish signal to equities at the moment. So going into the shortened holiday week of fairly light trading, we certainly are on the pivot of what could be the start of a fairly significant bullish trend here in overall equities. So I would say a pretty positive tone here to the markets overall. The Russell 2000, the IWM ETF, which tracks these Russell 2000 small cap ETF, also right now breaking out above some major resistance levels, showing us the opportunity not only across the large cap, mega cap stocks, but actually a larger potential opportunity in small caps. We've seen small caps actually outperform large cap in the past week or so. And I would say that as equities start to break out higher here, there's actually a further opportunity for small caps to continue to play catch up here and actually continue to outperform large cap for some time, or at least the opportunity for that. So, when we look at small caps are not as oversold and not at the same level of resistance levels as the large cap, mega cap indices, and has even further upside opportunities, in my opinion, relative to the mega cap indices. And then if we take a look at here, the growth versus value index. So basically, if this chart continues to move up to the upside, that's really where we continue to see growth outperform value, and that is at the moment what we continue to see. This trend, as you can see, this trend that has been in place since the beginning of 2023, showing that growth is outperformed value. Granted, the pace at which growth outperforms value is slowing down a little bit, but the direction is still very much up to the right, giving us further evidence that, as you're looking for further upside here in equities, it's really the growth names that's providing performance relative to the value names here at the moment. Looking at commodities, this is really where last week we saw a continued decline here in overall commodities, but we were sitting against this major support level here, looking at GSG, the Commodity Index Trust for the S&P Commodities Index. And what this provides me with is a little bit of evidence that, the sell-off we've seen in commodities over the past couple of months is perhaps showing some level of support here at the moment. If it does break lower from this, this is really where there could be further downside here across the commodity sector. Now, this index includes a lot of different commodities, not just gold and silver. So this is one worth paying attention to, but at the moment, my base case here is potentially looking for a little bit of a bounce here from some of the major commodities as we've reached these major support levels. But one of the big changes here in terms of asset classes this week is really the big move we've seen in high yield corporate bonds. This is a weekly chart of high yield corporate bonds, HYG ETF, and over the past few months, we've been referring to this trading range that the markets have failed to break out higher from multiple times. But last week, we really got the first major breakout here to the upside. And this starts what is the start of a bullish trend here for high yield corporate bonds. This certainly has ramifications across the board for support for high yield. And this is a pretty clear risk on indicator that the market is providing here at the moment. Bonds that have obviously riskier debt being purchased and breaking out to new relative highs provides some level of confidence here to the overall market. And the breakout here to the upside, beyond its trading range that it's been stuck in for the better half of almost 2 years, is showing us some signs of a risk on indicator here from the bond markets here at the moment, which gives us a little bit further confidence in the potential breakout here for equities at the moment. Looking at the VIX, we did see the VIX trade back below the 14 handle at the end of last week. This certainly alleviates a lot of the fear we've seen in the markets over the past few weeks as we were trading into that 21-22 range. We've seen a pretty significant reversal here in terms of volatility back down to levels that previously throughout the year have been opportunities to be long volatility. Now, that's for most of you that are options traders, thinking about what type of option strategies you might want to deploy with volatility at such relative low terms. Gives you an opportunity to potentially be a buyer of volatility, being long options, long calls for bullish views here in the market, long puts for bearish views here in the markets at the moment. Looking at the 10-year yield, we continue to see the 10-year yield kind of trade at the moment still above this 4.4% level, but this is the key level to pay attention to. At the moment, there certainly seems to be the opportunity for yields to actually continue to decline below this 4.4 level. Declines below 4.4 will target 4.2 here to the downside, and even down into the 4.0 level here to the downside. Now, if we continue to see bonds bid up in price, which means corresponds to a lower yield, that will also provide the support for the bullish view here that we generally have overall for equities. Looking at TLT, the long dated bond ETF that has been a long-term downtrend here for quite some time. We have started to see some improvements here in terms of momentum here to the upside. As you can see, MACD starting to cross over here, so momentum showing signs of positivity. Now, we'll see how much further this can rally, but certainly 92.27 is the first minor level of resistance, but the upside here is well into the low 100s. In terms of upside here for TLT, that would be our first level of upside targets for TLT. So on the verge of a potential fairly significant breakout here for bonds, which, like I said, corresponds to lower yields, providing that tailwind for equities to break out above those double top levels and continue moving higher. Looking at the US dollar here, this has been a pretty significant decline we've seen here in the US dollar over the past week or so. The dollar having gained quite a bit of strength here over the past few months, consolidated over the last 4, 5, 6 weeks or so, and just last week broke below that trading range. And this is the first significant move we've seen to the downside in terms of the US dollar. Now, there is some support coming in around this 103 level, and we'll see how the US dollar responds to this level. But from everything that we've seen across the board from equities and bonds, my first base case is for the dollar to break lower from here, which has obviously big ramifications for those of you that are currency traders, as well as for those that trade commodities that are denominated in US dollars. Because as you can see in the USD, Euro USD, we've seen a fairly significant breakout here in terms of the euro above this 106, 107 resistance level, back above into the 109 level. This starts to open up, fairly significant upside here in the euro dollar, as well as here in commodities like gold. As dollar continues to weaken, this provides support here for gold to try to rally back into this 2080 all-time high of gold, as well as, we're starting to see oil find that support here around this 72, 75 level here to the downside, and potentially bounce back modestly into the low 80s here at the moment as a potential upside for oil at the moment, finding a little bit of support going into the OPEC meetings this week. Expectation potentially of further cuts that could provide some upside here for oil. Looking at the relative rotation graph here, really, when looking at sectors, consumer discretionary and technology are the two sectors that continue to be in the leading quadrant, showing both relative strength and momentum, while utilities and energy, consumer staples, healthcare continue to lose momentum here, with some of these other sectors here sort of in the middle, not really gaining much relative strength or losing much relative strength with much momentum here or so, where we have communications, industrials, materials, financials, and real estate. So the big movers really are discretionary, technology, utilities, and energy losing that strength here at the moment. Another way to take a look at this is you can view the sectors using the options play tool that you guys have access to, sorting the sector spiders by strength. And what you have seen here, the big change that we've seen here has really been in the number of sectors that have turned green across the board. So we have 7 sectors now that have showed short-term and long-term bullish trends, which was an improvement from the week before, which had 5 sectors showing that green trend sector. So we continue to see trend quality improve across the sectors. Right now, we currently have 4 more sectors that are, in the process of turning around. 3 of which have already started to show early signs of trend reversal in healthcare, in staples, and utilities. But as you can see, the long-term trends for those sectors are still at the moment either neutral or bearish, but showing some early signs of some reversal, with energy still firmly in the bearish trends, both in the short term and long term at the moment. So that's kind of how some of the developments we continue to see in these sectors here at the moment, looking for opportunities, is sorting for that sector. So looking at the individual sectors, technology sector is really the one that we see strength here, breaking out to new highs on both an absolute basis as well as on a relative basis. So the top chart is the XLK ETF. The bottom chart is the ETF relative to the S&P 500. So what we've seen is this is the only sector out of the 11 sectors that has broken out to a new absolute high that's also been confirmed by a new relative high. So out of opportunities here in the market, technology remains kind of the strongest of the sectors. Consumer discretionary showing some strength here, breaking out to new relative highs. As you can see, breaking out to new relative highs that has been confirmed with some strength here in terms of the relative strength to the overall market. So consumer discretionary and technology are the two strongest sectors here at the moment from a relative strength perspective. Energy is continuing to lose ground here at the moment, finding a little bit of support, I would say here. As you can see, you're no longer really making continued moves to the downside from an absolute basis, but on a relative basis, energy losing that ground because as equity markets bounce, energy not seeing those bounces alongside with it. So looking at some opportunities here in the market, and this is looking I would say looking for opportunities in this market is difficult from the perspective of if you agree with the bullish views here in the broader markets. If you look at a chart of most sectors, the risk to reward does not favor being long at the moment, meaning most sectors are near major resistance levels, meaning your upside here is fairly limited in terms of nature versus the amount of risk that you'd have to take is fairly significant relative to the potential performance. So even if you're in the view that equity markets are likely to continue moving higher, the risk reward of entering new long positions, mostly across the board right now, is not very favorable, which means that looking for opportunities in the market where risk reward is favorable is actually very difficult to do. But one ETF that did that was brought to my attention that I think is worth potentially looking at is any of the marijuana ETFs. And I'm just using MJ as an example. There's many other ETFs that you can look at in this particular space, but it certainly is showing some signs of strength here, improving relative strength. We saw a couple of months ago a pretty significant move here to the upside, which actually gave up all of those gains but starting to form another base here again around this 228 level here to the downside. Could see the potential upside here, very early days. But like I said, not many ETFs that provide the risk reward ratios that are favorable here at the moment, where the upside potential is larger than the amount of risk that you'd have to take in order to achieve that. But marijuana certainly fits one of those potential criterias of where risk reward right now on the long side is still relatively favorable. Another one is retail. When we look at consumer discretionary's risk to reward ratio isn't that strong, but retail looks a little bit better. XRT ETF, the relative risk to reward here is fairly balanced as opposed to skewed against you. And as you can see here, while we haven't seen much gain on the relative chart, we certainly have seen on the absolute chart, XRT has kind of formed this base and started to break out here to the upside. Looking for that continuation into the $68 recent highs as your first immediate target here to the upside, while taking on a fairly small amount of risk relative to that upside potential in XRT. And what we'd love to see alongside with that move here to the upside is a continuation of the potential upside on the relative chart here as well. And XHB, which is the home builders ETF, This is just another sector that we kind of track to give us an understanding of kind of how the economy is doing, showing some continued improvements both on the absolute chart as well as on the relative chart, breaking out to new relative highs. This gives us confirmation of kind of the strength of the equity markets and how the home builders are currently performing at the moment. And so far, that strength is confirmed by home builders. But like I said, the relative strength here right now on a lot of sectors, I'm sorry, the risk to reward ratio on a lot of sectors do not look particularly favorable to establish new long positions because, again, the upside to resistance levels is very limited compared to the downside to the next support level, where the risk reward just doesn't favor establishing new long positions in these sectors such as XHB. And a lot of sectors look more like XHB than they look like the retail ETF or the marijuana ETF. And that's really, I think, the biggest challenge that I see with trading the current market, where if you're thinking about how do I play this market right now, being in small cap where the risk reward is still a little bit better favorable in large cap, looking for sectors that are not as near those all-time highs is really where you have to be fairly selective right now, so that the risk reward is still relatively favorable for you to establish new positions right now. And obviously, one big one that we all have our attention on right now are semiconductors, with NVIDIA reporting earnings this afternoon. I think that's the major report that everyone has their eyes on. NVIDIA just near those all-time highs as of this morning's open. The question is whether NVIDIA continued to deliver a blowout earnings that justifies the equity markets to reprice NVIDIA back to new 52-week highs, or this becomes a bit of a temporary top here in the broader markets. So a lot riding on, I would say, the overall sentiment with NVIDIA's earnings this particular week, and really gives investors a glimpse into whether or not the AI hype that has driven the equity markets over the past few months has really converted into actual revenue for companies. There's a lot of hype, there's a lot of interest in it, but can it convert into actual revenue for companies like NVIDIA, where there's direct revenue? Great. But will that trickle down into other companies like Microsoft and Adobe and Alphabet and Apple into additional revenue for those companies? That's yet to be seen over the next couple of quarters. And NVIDIA is obviously going to be an important sentiment indicator of investor appetite for AI. So this afternoon, a very big signal that we're going to get from the NVIDIA earnings. So the semiconductor index breaking out to new relative highs near kind of some major resistance levels, time highs, which is just above 530 or so. But as you can see, breaking out to new relative highs breaking out the new absolute highs has been confirmed by breakouts the new relative highs, which is a fairly strong indicator for NVIDIA going into earnings. So at the moment, I would say investors are fairly on the optimistic side and positive side in terms of expectations for NVIDIA, but yet to be seen this afternoon. So really, really important things to pay attention to here right now. Like I said, shortened week this week, light trading week because of Thanksgiving. But that hopefully gives you an overview of kind of where we currently stand with the equity markets, with the major asset classes, commodities, the US dollar, and the overall sectors currently of the US equity markets. With that covers what we wanted to share with you here today. Like I said, I'm stepping in for Prakash this week because he's getting married this week. So he's taking a little bit of time off, and I hope everyone here has a fantastic holiday week, and happy holidays. And we will see you back here after the Thanksgiving weekend. Thank you so much and have a great trading day.